In today's private market pulse snapshot, the one thing I'm focused on is this: what the iCapital fourth quarter 2024 flow of funds data is telling us about investor activity within alternatives and specifically in the private wealth channel. Looking at the numbers, the key takeaway is clear. Demand for alternatives remains strong, although allocations within each asset class are shifting. But broadly speaking, over the past few quarters, we've seen sustained appetite for private credit, a pickup in private equity, and continued growing interest in infrastructure funds. And notably, by the way, hedge funds had a record spike in interest in the fourth quarter. So let's take a bit of a closer look at these numbers. First, private equity. It still represents the largest share of our platform assets at 39%, and we have seen an uptick in demand over the past few quarters. And while it captured a smaller share of the overall flows in the fourth quarter in particular, capturing about 30% of the overall flows, investors clearly continue to commit capital to this sub-asset class. So why is this? Well, we think a few factors are at play. First of all, the U.S. economy continues to be on solid footing. And second, this combination of modest interest rate relief, potential deregulation, all of that improves the outlook for capital market activity and bodes well for private equity. Private credit allocations continue to climb higher. Private credit made up 35% of the overall flows in the fourth quarter and 38% in all of 2024. What's notable, though, is that private credit's share of our total platform assets has nearly doubled since 2020, jumping from 17% to now over 30% today. Now, within private credit, direct lending strategies, which continue to offer yields of around 10 or 11%, they remain dominant. But we did see the appetite for distressed and opportunistic strategies soften slightly versus last year. The bigger picture, though, is still the same. Banks are still cautious on lending, and direct lending and other private credit strategies continue to fill the gap, providing attractive risk-adjusted returns for investors. Third, let's take a look at real assets. Here, investor preferences have been changing. Commercial real estate remains the largest component within real assets, but infrastructure demand is growing and growing fast. Indeed, 35% of real asset flows went into infrastructure funds in 2024. That is up from 20% in 2023 and is up from just 8% in 2022. So this shift makes sense because you have these secular growth drivers of infrastructure that are at play, like the need for upgrades, the global energy transition, and the rise of AI and data centers. And that is on top of this history of strong risk-adjusted and inflation-protected return profile. All of that is appealing to investors. Now, unlike infrastructure, real assets share of inflows has declined, falling from 92% of real asset inflows in 2022 to 63% last year. However, we think this trend could start reversing in the coming quarters. And in fact, we've recently upgraded our core real estate outlook from neutral to positive in our latest private markets and hedge fund strategy ratings, because we think the worst of property value declines may now be behind us and prices of commercial real estate may inflect higher in the coming quarters. And finally, fourth, let's take a look at hedge funds. Hedge funds saw a significant spike in their share of flows in the fourth quarter, accounting for 23% of flows. That is the highest quarterly level on record. Now, reading into this, investors may be positioning for a more volatile macro environment in 2025, with a potential opportunity specifically in macro and multi-strategy funds. But then there's also this expected uptick in capital market activity, and that could benefit event-driven hedge fund strategies, which our team has also recently upgraded. Now, the bottom line is this: private credit continues to be the standout. Private equity is certainly gaining momentum, and investors are increasingly looking at secular tailwinds in infrastructure. As we head into 2025, investor positioning within alternatives will continue to evolve alongside the shifting macro landscape, and we'll be sure to keep you updated. And that's your one thing in private markets this week.